My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make you a little money. My job is not just to entertain, but to educate and to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. We were due for today's modest pullback. The S&P had been up 8 straight days. 9 straight would have put us in rarefied territory. We haven't had that kind of winning streak since 2004. Of course, the session was rough. Dow off 62 points, S&P dipping 0.2%, Nasdaq losing 0.33%. But we got to wonder whether the market still has the horses to go higher. Because today, we got bad news, and guess what? Stocks actually went down, that bad news. That's something that didn't happen much during the 8-day scheme. You see, we had very odd pattern going on during the winning streak. It was a bit of Pangloss and a nip of Camelot. When a company reported a good quarter better than expected, it stock zoomed. When a company reported a better than fear quarter, the stock roared. When a company reported a bad quarter, we decided that was the last bad quarter because the Fed's about to cut rates. So it's no big deal. Go buy anyway. In other words, companies could do no wrong. But not today. Today we had a bit of a reckoning, a dose of reality being thrown in our faces. Let's start with Lowe's, the home improvement chain we all know. The quarter was weaker than expected, but not by much. Management explained that there simply aren't enough housing transactions going on for them to make the numbers. As CEO Marvin Ellison said, I quote, people aren't moving nearly as often as they typically do because current mortgage rates are so much higher than their existing rates. Marv goes on to say, as a consequence, housing turnover is hovering near its lowest level since the mid-1990s. And the preference of spending on services, especially for the more affluent consumer, well, has persisted much longer than expected, end quote. Lowe's also talked about weakness in big-ticket items. Homeowners are deferring their projects. They mentioned a great deal of uncertainty, particularly around interest rates and inflation. People who locked in lower rates before the Fed started tightening simply don't want to take out a new mortgage with much higher rates, to say nothing of home equity loans, which is how you usually pay for these big-ticket items. So Lowe's cut its same-store sales forecast almost as much as Home Depot did a week ago. In fact, the quarter was practically a mirror image of Home Depot. Maybe better, though. When the despot reported, though, the stock dropped 15 points in pre-market trading, I took to X or Twitter or whatever and said that was ridiculous. You had to buy it. Sure enough, you just had to. Do you know it's now rallied 40 straight points from there, and it's only been a week? But Lowe's had a little bit better quarter, and the stock went down $3. And then it roared higher, but then it came right back. It took me like a mini Home Depot. Plummeted, finished the day down, back 3 points. It was bad news. And bad news was bad news, and it took a lot of people by surprise. So if we step back, we have two companies, same business. One ultimately goes up huge on a weak quarter, and one got hit on a similar set of numbers. What does that tell us? First, Home Depot reported a perfect moment when we felt that if you do well, you go higher, and if you do poorly, the Fed cavalry will be there to save you. But 7 days later, 7 relentlessly positive days, we have to believe the stocks will no longer get the benefit of the doubt. We're too high. We're back to business as usual, where the good go up and the bad go down. The market's now sufficiently rich enough that we can't just say to the bears, heads I win, tails you lose. At these elevated levels, there's some rationality, and rationality is an anathema to the kind of move where everything can rally. Doesn't help that many expect the Fed cavalry to appear on Friday when they venture west to Jackson Hole. That's a lot of potential sellers if things don't go their way. And I got to tell you, they will be sellers. It's a Friday, summer. In the end, Lowe's got hit because we may be dealing with a scenario where they need multiple rate cuts. And there's no sign of that. And they may not get enough to make it so their business turns around. Suddenly the market's less forgiving. Suddenly the market's asking questions like I just did. Here's another one that's like this. How about Boeing? This morning we learned that Boeing discovered a structural problem in the 777X involving the engine's connection to the plane. Suboptimal. But for the last 5 months, Boeing's been a comedy of errors, and it hasn't hurt the stock one bit. The thing just hangs in there, a function of its duopoly with Airbus. No matter what they do, Boeing stocks seem to be immune because Airbus and they are the only two that can make planes. Not today, though, Satan. Today, the news stuck, and the stock dropped 4%, leaving us to wonder if aerospace has finally left Camelot. I think it's incredible that Boeing's been able to stay up for so long. It's a totally fraught situation, one you definitely don't want to wade into. Hey, look, if you're looking for aerospace, then go buy RTX, which gives you the engine that hopefully stays attached to the plane, which is helpful. Let me give you another one. Estee Lauder reported an okay number, but then gave you a seminally horrendous forecast and an announcement that Fabrizio Freda would be retiring. They would have been fine if they had a new CEO lined up. Oh, no, but not these guys. Freda's going to stick around for another 10 months for whatever reason. And what happens? The stock spent most of the day in positive mode yesterday. We were selling for the Chapel Trust when it was going higher. We couldn't believe anyone was paying up for the stock. Today, same set of circumstances. What happens? The stock gets hammered. Finishes down 2%. Delayed reaction or just a different mindset? I think it's a different mindset, where the market's no longer giving companies the benefit of the doubt, especially the ones like Estee Lauder that didn't deserve the benefit of the doubt. Let's go healthcare. One of the most dramatic declines of this year came from Dexcom, an old favorite of ours, but we haven't talked about it in a long time. It's the maker of blood sugar monitors for people with diabetes. In the last week of July, the stock fell from 111 to 64 in one of the most brutally missed quarters I have come across. Since then, though, Dexcom's been creeping back up. It's getting all the way, go step by step, inch by inch to $77 last night. And then, bam, Eli Lilly releases a 3-year study on its revolutionary GLP-1 drug, and we learn it can prevent 94% of at-risk patients from developing type 2 diabetes. I don't want to take anything away from Lilly's achievement. I'll talk about that later, especially since it's a big winner for the Chapel Trust. But these results were basically in line with every other window that the drug's been measured against. This time, though, Dexcom got clocked down 6%. Because obviously the GLP-1s, they're bad for the diabetes monitoring business, and today we cared about it. Finally, one other thing to worry about. We had the wrong stocks go higher. We've had a broad market, but today it was narrow. The staples, Procter & Gamble, Colgate, Clorox, and the like, they were on fire. Now, some of that's because the dollar's gotten much weaker, and these companies tend to sell a great deal overseas, although that's not really the case with Clorox. But when you see the kind of strength in the recession-proof stocks, it's a sign that Wall Street's may be expecting at least some cohort, not good news from the Fed on Friday, and therefore a slowdown, a bad slowdown. Now, the good news is that these are all subtle. There was no head bashing here. We're not having one of those roaring openings and then a pirouette down that takes your breath away and causes people to run for the hills. Get out now. I don't see the recklessness and the greed that abound at the top. But the bottom line, we're getting back to reality. We're good is good, bad is bad. Never the twain shall meet. In short, the market's rational again. But maybe that's the point. The 8 days up, they were the outliers just were given some weakness in so much of the macro data and that excessively, endlessly forgiving exuberance. Well, maybe they do have to be tempered, like today, before we can mount another rally. Let's go to Trey in Texas. Trey.
Jim, I was halfway through a Mexican pizza last night when I realized I've once again failed my diet plan. But you taught me to look for opportunity in everything. So I developed an algorithm from which I seek to identify earnings beats for restaurants by tracking my weight daily throughout each quarter. Needless to say, Jim, Q3 looks like a huge beat for Yum Brands. Would you agree?
Well, I think that you ought to test your luck with Darden, with the never-ending pasta bowl that just came back. I think that Darden's better than Yum because I tell you the truth, you ain't get no Mexican pizza at the Pizza Hut, which, by the way, has pizza that frankly reminds me of the pizza when Pat Doyle started at Domino's. You remember the kind that was a little more like shirt cardboard? What can you do? Let's go to Eric in Florida, please. Eric.
Booyah, Jim. Long-time listener, first-time caller. Thanks so much for having me on
We
tonight.
need some new blood. We have been getting a lot of the same people from Illinois. Getting a lot of people. Can you give me some new blood like this fella? Thank you.
Hey, thank you, Jim. I just spent so much money at Disney over the past weekend. The stock is at a 10-year low. Is it a buy? What do you think?
Didn't he? Yeah. I think it is. I wanted to buy some today. I wanted to buy some yesterday. Jeff Marks and I have been going hammer and tongs about this. He doesn't seem to want to pull the trigger. Reminds me that we're very overbought. But I'll tell you one thing, Disney's not overbought. Disney's horrendous. Maybe that's why you should buy it. Today's market was, didn't fit today's template, where good news is good news and bad news, like we've been getting from Disney, is bad news. In short, maybe the market's getting rational again, which you actually need to sustain a higher advance. Mad Money tonight. Could an investment in Sweet Green help your portfolio make some green? I'm slicing and dicing into the company while I also have some Mexican pizza. Then we're taking technicals with the chartists who predicted the pullback in high-flying tech stocks this spring. No, you don't want to see it, and it has to do also with a stock that's going to report next week that you may have heard of. And but you got some confusion maybe over Confluent. After reporting a month ago, the stock dropped 17% in a single day. Today, I'm getting a read on potential turnaround, emphasis on the word potential, with the company's CEO. And I want you to stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Quick. What's the best performing restaurant stock in the Russell 3000 this year? It's not Wingstop, which is having another great year, up 46%. It's not Brinker International, parent of Chili's, up 54%. It's not even Cramer fave Cava Group, the valedictorian of the IPO class of 2023, up 129% year to date. No, the best performing restaurant stock this year is Sweetgreen, the salad chain, with a stock that is nearly tripled.
That was easy.
That's a pretty shocking number, not only because this has been a tough year for the restaurants, but also because not that long ago, Sweetgreen looked like a total dud. This thing came public in November 2021, right near the peak of that period for the highest growth stocks, remember? And at $28 per share, then the stock doubled in the first 2 days of trading, jumping to the mid-50s. But like so many IPOs of the 2021 vintage, the darn thing just collapsed. Ultimately bottoming at $6 and change in March of last year, down nearly 90% from its highs. This one was one of the goats of the game. While I like Sweetgreen, the restaurant, and a lot of people in the office really love to take out from there, I've been a true hater of Sweetgreen, the stock, ever since it came public. I told you to steer clear of it in November 2021 and then reminded you not to stick your neck out for an unprofitable company in June of 2022. Hey, those turned out to be good calls, as this thing was still trading in the single digits as recently as January. But I never really circled back to the story after Sweetgreen found a bottom, which is why its spectacular rally this year did catch me by surprise. So what the heck changed to make this stock such a winner? First, looking strictly at the numbers, Sweetgreen is consistently generating earnings before interest, taxes, depreciation, and amortization. They had positive EBITDA in 4 of the past 5 quarters, highly unusual. That's a much more forgiving metric than earnings per share, but at least companies moving in the right direction on the profitability front. Second, and more important, the same-store sales growth, how we really measure things around here, has come roaring back. Sweetgreen was putting up 25% same-store sales growth when it came public in 2021. Clearly not sustainable. Slowed to 13% in 2022, then 4% last year. In the last 4 quarters, though, their comps have re-accelerated. Last time the company reported, they were up 9%, projecting 5 to 7% growth for the full year. That is fantastic. How did Sweetgreen generate those numbers? For starters, I think their focus on healthier meals and a more affluent customer base gave them a structural advantage at a time when the broader quick-serve industry struggles with pushback on pricing for lower-income consumers. Plus, they made some big improvements to their loyalty program, and they already had a strong digital ordering system. A lot of companies don't have that. But mainly, Sweetgreen stopped being so hung up on the idea of being a salad place. In the past, they've been occasionally introduced different seasonal salads, which never really drove new traffic. Last year, though, this salad chain started selling something other than salad. They made some big bets on protein, starting in the spring of 2023, when they rolled out a chicken burrito bowl with 0 leafy greens. The change really began to take hold last fall when Sweetgreen decided to tackle dinner with new protein dishes, including a very good miso-glazed salmon plate. And the company keeps getting better and better at this type of thing. This past spring, they went all in on the new strategy. Now you can get a caramelized garlic steak from Sweetgreen. Sounds good, doesn't it? Well, not if you're a vegan. When the company reported its most recent results 2 weeks ago, that steak was the first thing management cited to explain the terrific 9% same-store sales. So it's actually a fun conference call after a lot of Sturm and Drang. These new non-salad options have brought in lots of new customers while improving traffic both during dinner hours and on weekends. Makes sense. They sell actual meals now. People are happy eating a salad for lunch, sure, which is why Sweetgreen's always crushed it during the part of the day. But they struggle later in the day because salad for dinner sounds a lot less enticing. So it's menu innovation and the embrace of protein. That's what's driving Sweetgreen's revenue growth. At the same time, they've embraced efficiency in order to bolster the profitability. Management's made some big investments in automation, the infinite kitchen concept that allows them to prepare food faster with fewer people. And you can actually watch the machines at work. While this technology only has been rolled out at a couple locations, their restaurant margins are already 10 percentage points higher than the fleet average. That is gigantic. This year, Sweetgreen's plans to open 24 to 26 new locations, 7 of which will have the Infinite Kitchen technology, while another 2 or 3 locations will get retrofitted. During the dark days of 2022 and 2023, when the stock was getting killed, management promised to dial back their store growth ambitions, or to focus a little more on profitability. And now they're very much delivering on that promise. Others I know are still in a hurry to put up stores. I say, here's your hat. What's your hurry? Don't let the door hit you on the way out if you're just putting up stores for empty calories. At this point, Sweetgreen's ready to start really expanding again, but at a doable pace. When the company reported 2 weeks ago, CEO Jonathan Neiman said the plan is to go back to new unit growth of 15 to 20% per year. Given that they currently have 225 locations, that would mean roughly 35 to 45 new ones next year. That is a manageable pace, people. And since they figured out how to generate more traffic while running a tighter ship, adding new stores has become a much better business proposition. So now for the million-dollar question. Is Sweetgreen, the stock, worth buying up here, even though it has nearly tripled year to date? Some say no. Stock was up a lot before Piper Sandler downgraded from overweight to neutral. Monday really caught my eye. Sent the stock from 37 to 33 and changed over the past 2 days. But that pullback happens to be the reason I'm willing to endorse it. When I look at the Piper Sandler downgrade, you know what? I didn't see all that much to be worried about. This was part of a broader bearish call in the fast casual dining space. In fact, if you look at the report, it actually reads more positive than negative. But before the analyst concludes with, quote, we think the risk reward has become more balanced at current levels, end quote. End quote. We wouldn't be surprised if absolute share price upside was a bit harder to come by over the balance of this year, end quote. That's hardly a vicious takedown, right? Given that the stock's now pulled back 12.5% from the last week's highs, I'd be tempted to start building a small position in Sweetgreener. However, considering that we're headed into a seasonally choppy period for stocks, I wouldn't be surprised if this one gets knocked around a bit. Maybe you get a little bit in now and you buy some at lower levels. But the bottom line, if Sweetgreen stock keeps getting slammed like it has earlier this week, I think you should pounce. Because this is no longer the unprofitable salad chain of 2 or 3 years ago. Not only does Sweetgreen get religion on profitability, it eagerly slaughtered the sacred cow of being a pure salad chain, and now it's serving that cow for dinner.
House of pleasure.
You got my blessing to pick up the stock here, and then maybe buy some more if there's a weakness, something that might be given as the rotation inside the restaurant group is about as vicious as they come. Mad Money is back after the break.
Coming up, are the charts of a Cramer favorite signaling softness? Cramer chews on the dog days of summer. Next.
As I said at the top of the show, this can be a truly confusing moment for the market because we're in the grip of not one but 2 cross currents. On the one hand, there's the business cycle. We know the economy is slowing, and unemployment rates rising while inflation finally seems to be cooling down. That's why Wall Street's now expecting the Federal Reserve to start cutting rates at the next Federal Open Market Committee meeting. That's in September. Something that should be fantastic for both the economy and the stock market. We'll hear more from Fed Chief Jay Powell at Jackson Hole later this week. But for now, we don't have a lot of clarity on how aggressively they might be willing to cut, in part because the economy is proving more resilient than you might expect. But on the other hand, we're 2.5 months away from an extremely polarizing presidential election. It's looking like a close race, which makes it hard to bet on Trump stocks or Harris stocks, because either way, the odds just aren't that good. At the same time, Wall Street loves to focus on the potential negatives in the months leading up to the election. Hence, all the focus on what Vice President Harris means when she talks about gouging and going after the price gougers, or whether former President Trump will truly be able to implement a 10% tariff on imports. You can argue about these policies, whether they'll be good or not for the economy. But from Wall Street's perspective, they're certainly not helpful for the stock market. In short, even though I think things are looking up as we get closer to a new rate cut cycle from the Fed, this is a tricky moment. It's full of uncertainty. You know what I like to do in that case? I like to consult the charts and the history to remove our subjective judgment from the equation, focus on something more empirical. So tonight we're going off the charts with the help of Larry Williams. He's a legendary technician, market historian, who's been the best in business since I was in grade school. He's written over a dozen books, created a ton of proprietary technical indicators. We use a lot of them on the show. Larry's also made some incredible calls for us in the last few years. He called the COVID bottom when everyone else thought the sky was falling. He nailed the market-wide bottom late last October. He predicted a pullback in high-flying tech stocks this spring, and both when it began and, more importantly, when it ended. How does Larry do it? He analyzes cycles. He looks over history, spots patterns that seem to repeat themselves in the averages or individual stocks, and then projects them forward into the future. And that's why I like his approach. Sometimes we can find an explanation for why these cycles behave the way they do, but often the historical patterns simply seem to repeat themselves for no discernible reason. When the market's full of tricky cross currents, Larry's cycle analysis can be your North Star because it doesn't depend on what you think about the Fed's next move or who won the election. Those are irrelevant. Some critics say reading the charts is like astrology, but if you can find me an astrologer with a stock picking record that comes close to Larry's, I'm going to put him on air. In this business, it's a mistake to argue with what works, even if you can't figure out why it works. Hence the stuff we do with when we do Fibonacci analysis on the show. With that in mind, take a look at this daily chart of the S&P 500 with Larry's short-term cycle forecast in red and his longer-term cycle forecast in blue. These are based on analyzing data from different periods of time. When you look at Larry's long-term cycle for the S&P, it says we should expect real selling pressure until the cycle turns positive again in mid-October. As for the short-term cycle, it's saying something very similar, predicting a period of weakness from the beginning of September. Okay, we're coming into that, okay? And you can see short-term is red. From the beginning of September, and it goes through mid-October. These cycle forecasts are how Larry tries to predict the future without knowing exactly what's coming. In his view, if you want to know why a turn happens, you have to wait until after the turn plays out, which is not very useful, is it? Unfortunately, a shorter-term forecast says the recent rally is pretty much, and he used this word directly to me, kaput. That jives with what we've seen on the short term, that short range oscillator that I've told you about. Like I told you last night, we're overbought. When you get overbought, you need to raise some cash. We did it again for the Travel Trust today. As Larry sees it, this rally will likely run out of steam near the end of the month before giving us a brief bounce in mid-September and then hitting us with a nasty leg lower through the middle of October. You can see both cycles indicate that. He wouldn't expect a sustainable rally until about 2 months from now. But at that point, both this long-term and short-term cycle projects project that we're going to have a nice run. And you know what? You'll take this, won't you? I will. That said, keep in mind that Larry's cycle forecasts are more about predicting when the market's likely to change course than they are about predicting the scale of a given move. Right now, what matters is that the music's ending, the dancers are all about to leave the floor, at least according to this chart. Of course, as much as we care about the averages, Larry is adamant that the true linchpin of this market this year is, I almost feel like you can guess it, right? It's NVIDIA. It's the king, and the rest of the market is made of its pawns. They march to the beat of NVIDIA's drum. Remember, this morning when I was talking to Carl, I said, look, NVIDIA is almost too important. There's too much pressure on NVIDIA. Can it sustain it? I don't want NVIDIA to be Samson. Take a look at this daily chart of NVIDIA going back to February. By the way, he's the one, Larry told you to sell NVIDIA a few days before it peaked in the spring. Remember that peak? Then he predicted the stock would take off again in late May. Meaning he's got a lot of credibility here. Larry's NVIDIA calls have been guided by the stock's short-term cycle in red, which you can see has followed the share price surprisingly closely. Really good, huh? That's unfortunate because look what the short-term cycle says, all right? Now projects that NVIDIA should peak sometime next week, leading to a sell-off that will likely extend through mid to late October. Now, remember, NVIDIA reports next week. The long-term cycle calls for the bottom at the same time. Given that Larry sees NVIDIA as the linchpin of the market, it makes sense that his cycle forecast are predicting that this stock should take a turn for the worse and then bottom along with the same trajectory as what he's expected from the S&P 500. Yes, NVIDIA is that powerful. I keep telling you that. And next week is a fulcrum week, bottom line. The charts as interpreted by Larry Williams suggest that we're likely in for some pain as August comes to a close. Pain that he predicts will continue through mid to late October. Now, I hope he's wrong this time. But it pays to take his analysis seriously. And for my money, there's a very good chance he could be right, particularly if NVIDIA gives you an outlook that is not that strong. Let's go to Henry in North Carolina. Henry.
Here's Henry.
Henry, what's happening?
Booyah, Jim. How's your day today?
Oh, man, my day is awesome. How about you, young lad?
I'm doing great.
Fantastic.
It's still hot out here, but I'm about to start my hockey season.
Oh, good for you. We're starting football season here. It's very cool. It kind of reminds me of football season. How can let's make money together. What do you have in mind?
I was wondering about Rivian for long term.
Are you old enough to drive? All right, that's neither here nor there. I think Rivian very long term is good because they actually have what I would describe as being a big backer. And so, therefore, they're not going to run out of money. Short term, it's going to be rocky because they do have a lot of things that they need to do in order to ramp up. So I'm not going to go jump on the short term. I will do because, hey, Henry, you got the whole life ahead of you. This might be a good one for you, as a matter of fact. Let's go to Joe, my home state of New Jersey, please. Joe.
Hello, Mr. Cramer. Thank you so much for having me on your show and for all of your great advice.
Oh, you're very, very kind. Thank you. How can I help you?
Okay. With company layoffs and a recent earnings beat, should I still hold on to Cisco?
Okay. Go good. I'm sorry. Go ahead. All right. Let me tell you how I feel about the Cisco quarter. I thought it was a very, very good quarter. And I think but then they didn't give you a lot of follow through to the quarter. So it felt like to me that you shouldn't chase it here over 50. But I do like what they're doing because I like what Splunk's doing. And Chuck Robbins, the CEO, bought Splunk at what looks like to be a pretty good price. So things are better. Inventory's clean. But I'm not going to jump up and down and tell you over 50 that you should buy all you can. That won't work for me. Let's go to Mike in Illinois. Oh, boy, we always have good callers in Illinois. Mike.
Hi, Jim. How are you?
I am good. How about you?
Doing just fine. I'm in a stock. My biggest dog right now, I'm down about 15%. It's Vistra, VST. I'm wondering if I should buy, sell, or hold.
You know, people think that Vistra is a defensive stock, and it's absolutely not. To me, it's too much of a dice roll. It's too much of a. I wish I had a chart of it because I would show you that this one has been straight up and then down. I don't want to touch it. It's too crazy for me. I don't want to throw in a two spot. I don't want to trust Constellation either. It's just two that I just find are like unfigure-outable. Not a great term, but I'm using it. The charts interpreted by Larry Williams suggest that we're likely in for some pain as August comes to a close. Oh boy, I hope he's wrong, but unfortunately, he's been right so often. Now, much more Mad Money ahead, including a Confluent conundrum after the stock's dramatic post-earnings drop and getting a read on what's next for the company with the CEO. Then Eli Lilly hit a new all-time high today, following positive data around its weight loss drug. What could it mean for the future of the stock? That new high was very important because we got rid of the double top. I'm digging deeper into the news. The oil calls rapid fire tonight's edition of the lightning round, so stay with Cramer. You know, I'm worried about the enterprise software category. It's been a very tough year for them. Take Confluent, next generation data analytics and data infrastructure company that a lot of companies can't live without. When reported at the end of July, the stock lost more than 17% of its value in a single day, 1.7. Why? Well, the actual results were actually better than expected. But management didn't raise guidance and instead gave, well, I guess you could say, somewhat cautionary comment. Back in March, Confluent was up nearly 50% year to date. Now it's in the red. The stock seems tempting down here, but we need more clarity. So let's go and check in with the source. Let's go to Jay Krebs. He's the co-founder, chairman, and CEO of Confluent to get a better sense of where this company's headed. Mr. Krebs, welcome back to Mad Money.
Hey, Jim. Thanks for having me.
Absolutely. Now, I've got to tell you, Jay, in a vacuum, I went over the conference call. I went over what you've accomplished. And I came back and I said, you know what? This actually was a good quarter. And the people who didn't like the quarter didn't understand that you're building long-term value here. They're jumping from one contract to another, even though you had a tremendous number of new contracts that came on. What are people missing about your story that because I think it's better than what the stock indicates?
Yeah, it was a solid quarter. You know, we grew 27%. We had really a record number of new logo ads, highest we've seen in 2 years. So both really strong signals of what's happening on the go-to-market side. As you said earlier, I think people would have liked to see raising guidance. We did see a little bit of pressure in the digital native segment, the tech companies, and that gave us a little pause when we consider the back half of the year, and that informed what we guided to. But when you zoom out a little bit and you look at what's the trend in this space, what's happening with data, what's happening with data infrastructure, data streaming, I think it's a very positive picture that you would hear directly from customers and see in terms of what the longer term trends are around AI and the use of data in enterprises.
Actually, one of my favorite customers of yours is Walmart, and they're using generative AI to actually improve their product catalog. Tell people how many people they would have needed to do what if you weren't there, to be able to make it so that they were able to provide the same level of service.
Yeah, there's incredible use cases in retail, and Walmart's a great example of that. Everything from managing the set of products that they have, the inventory that's in stock, and then driving a lot of the decisions in the business in real time. Having a much more dynamic view of how they manage this. And the addition of AI really takes out a lot of the manual work that would otherwise be there, allows them to classify products more quickly. So there's a really exciting set of use cases there that are just coming out into the market. And I think that'll be a great tailwind for Confluent over time.
I mean, my feeling about Confluent with Walmart is that if they didn't have Confluent, they wouldn't be doing as well against Amazon. And we'd be saying, you know what, they're just some old fuddy-duddy brick and mortar. But it's really important to be able to have that up-to-the-minute inventory that Amazon has, that I don't know if Walmart, they're great guys, but I don't know if they would have been able to do it without you.
Yeah, I think that's common in our space. When we look at our customer base, it's a combination of these tech companies that have built around this kind of technology from the start, and then more traditional enterprises that are moving towards it. And the pressure is exactly what you said. On one hand, you don't want to get out competed by the people who are innovating and have the new stuff. And I think that drives both parts of the business for us.
Now, in your conference call, you talked about a German company, 18 billion euro, that is doing something that I thought was extraordinary. They may offer some sort of deal or something that really gets people going. They only have 100 people in their call center. If they're overwhelmed, everybody gets angry. Now, we've all had to deal with this, every one of us, and we decided to hell with them. We're never going back to that store again, and we're never calling them again. You've been able to find some way to make it so that the companies aren't overwhelmed, even though maybe they would be without you.
Yeah. I think there's a great set of use cases, particularly around the use of AI. And it has to do with taking the data that is about that customer in that business, what they've done, what they've bought, what the interactions have been, all that kind of real-time context, and bringing it to bear in the moment to be able to answer questions and serve them better. And there's a bunch of variations on that, but that's a common pattern in the use cases for Confluent.
All right. Now, I want to understand, you said that you gave it, yes, it's true that the forecast was a little tepid, but at the same time, you managed to increase your customer count by 320 accounts. That's more than double the previous quarter, largest sequential growth in 2 years. So why wouldn't you raise forecast? Because those are incredible statistics.
Yeah, well, obviously, the current year in our space, there's been cross currents. Like on one hand, there's really exciting growth and projects happening. On the other hand, there's a lot more optimization of the cloud spend that customers already had. And so, you have on one hand a set of things driving growth, and you have another set of things that are, cannibalizing some of that growth. And, each quarter we're posting results that are kind of a combination of those two factors. And that makes it a little choppier than it would otherwise be. And, obviously we want to be cautious when we think about the guidance we give. At
the same time, let's think long term for a second. Gen AI is not going away. People are figuring out how to use it. They need help. And I know, by the way, EY wants your help. You've got these big, what I regard as being the great consultants that you turn to when you don't know how to do it. And they're turning to you. I mean, so this is something that's going to be with us a long time.
I think that's exactly right. Like when you think about the balance of forces here, this kind of optimization is a very short-term force. Hey, you're gonna try and save 10% by optimizing this usage pattern or that usage pattern. When you zoom out and you look at the longer trajectory of how businesses are going to be built, I think the enthusiasm in the data space, the enthusiasm about streaming and real-time data, what's happening with the AI, those are forces that are going to have impact over years. And, I think that's a really powerful tailwind both for us and some of the other companies.
Yeah, I agree with you. Now, look, if the stock were at 50, it would be a tougher call. Down here, I don't think it really is. I want to thank Jay Krebs, who's co-founder and CEO of Confluent. Jay, it's great to have you on. Thank you for explaining things.
Thanks a ton, Jim.
Absolutely. Mad Money's back after the break.
Coming up, hit us with your best shot. An electrified fast-fire lightning round is next.
It's time for the light round. That's where about the calls only. Same the stock tender buy, sell, just because another call stock questions that time. My stand principal graphics and buy. You plan to sell. And then the lightning round is over. Are you ready, Ski? The lightning round comes. Let's start with Sharon in Minnesota. Sharon.
Hey, Jim. It's Sharon. I'm a member of your club, and I really appreciate
Thank you so much.
But anyway, I wanted to ask about what is best of breed between Flutter and DraftKings. I'm going back and forth and just wanted to hear what you thought.
Well, you know what? As you get closer to football season, we start seeing a lot of daily fantasy. We start seeing a lot of people playing, betting on these games and betting on every quarter of the games. It's going to be very good for Flutter, which is a very well-run company. I would actually buy the stock. Let's go to Mario in Virginia. Mario.
Booyah, Jim.
Booyah.
I would like your thoughts on AST Mobile. The stock has been going up and up and up. Am I too late for this bull run?
Let's ring the register on that one. I mean, honestly, that's the kind of thing that I don't like. That's what worries me about the market, is things like AST. I mean, that just stuff just doesn't, it can't continue. Let's go to Harold in Wyoming. Harold.
Hi, Jim. I'm Harold from Wyoming. My question's about PayPal. In the past 3 weeks, the stock price has improved greatly. Can you tell me what or why the price has improved?
I'll tell you why. The financial techs have come back in style, and Alex Chris is a very good manager, and that's what's driving this. Let's go to Lewis in New York. Lewis.
Yes. Jim
Lewis,
Cramer?
you're up. Yes, this is Cramer.
Okay. First of all, let me give you a little tip. You left some money out by the state controller. It's under Cramer, Berkowitz Company, payee Jim Cramer from 2002.
Really?
I hope. Yes.
How much? Is it a lot?
It doesn't tell you. You have to look it up.
I'll go look that up. Hey, let's check on that. Let's check. Ben, can you make some calls here? All right, good.
Okay. So my question is LQDA, Liquidia, with United Therapeutics filing a lawsuit against the FDA and the FDA ruling in United's favor against their own rules.
Man, I'll tell you, that is just such a dice roll. It's been going down, down, down. The only outfit that really covers it is H.C. Wainwright. They talk a lot of like, this one is just too much of what I would say a black box. But I will check in the 2002 Cramer Berkowitz return, because maybe that's the kind of thing that could just make it so I can retire. Highly unlikely. Let's go to AJ in Colorado. AJ.
Hey, booyah, Jim from the beautiful Rocky Mountains. How you doing?
Oh, man, I love it out there. How can I help you?
Well, first of all, I want to thank you for giving me the education and, most of all, the confidence to make my own stock decisions.
It is about confidence.
You and NVIDIA have done it for me. Thank you so much.
All right. Now, remember, NVIDIA reports next week. I can't promise you anything, but we'll have more on that. But I will tell you this. We can keep working together because of the comments you just gave me, because I want to inspire confidence when it's based on homework. Confidence when it's not based on homework, very dicey. Based on homework, that's where the strength comes. How can I help?
Okay, I bought a small portion of a stock a few years back. I thought it'd be a great infrastructure play with a fantastic yield, but it's just been bouncing all over the place. Should I buy more, hold, or sell CCI?
I'm not a fan. In the old days, we made some money for the Charitable Trust. I am so glad we sold it and we never looked back. It just is not enough well-run management there. Good yield, but we need more than that. Let's go to Harish in Virginia. Harish.
Hi, Mr. Jim. How are you?
I am good. How about you, Harish?
Great. I'm watching your show long time. So my question today is Tesla. You know, I have
Tesla. Ever since 180, I've been saying Tesla's an up stock. I don't really care what people say anymore, because what happens is this man is now the master. He's going to tell about how it's a technology company. It's no longer just a car company. And people will lap that up. That's what they do. They lap up every word that he says. They can't show any rationality. They will not think about maybe it can't happen with the self-driving cars. They just said if he said it, then it must be right. Boy, we all wish we had that, don't we? Let's go to Karen in Ohio, please. Karen.
Hello, Mr. Cramer. First, let me thank you for sharing your knowledge and experience and making me a happy investment club member.
Oh, fantastic. Thank you. I'll tell Jeff Marks, too.
But before becoming a member, I had an advisor that put me in a pretty sizable position in FAST. I've had it.
Kind of a boring fastener, plumbing, lubricant. Look, I don't mind those kinds of companies at all. I wouldn't have a huge position, but that's fine, and it's done okay. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, a new drug from Eli Lilly could be a weight loss game changer.
I think this is a profound result.
Find profits in the pipeline. Next.
It's the end of the age of diet and exercise. Today, Eli Lilly announced that its novel weight loss and diabetes drug can actually reduce the risk of developing type 2 diabetes by an astounding 94%. And that's not among the general population. It's among the pre-diabetic adults, people who are already prone to getting it. Throw in this drug's ability to make you lose weight, and you better believe we're headed for a future where people simply don't care as much or worry about diet and exercise. After all, whatever they're doing, it isn't working as well as Lilly's tirzepatide. People don't have the discipline. They don't have the willpower. Very often they don't keep up with their diets and they can't maintain a workout regimen. Hence why Americans are so prone to obesity and in turn type 2 diabetes, which is a very serious condition. We've been hearing endlessly about these revolutionary GLP-1 drugs for some time, but there was always some skepticism about how well they perform longer term for long-term illnesses. Today, we got the results of a 176-week trial on Lilly's tirzepatide, and we learned that it's a game changer when fighting diabetes. It also resulted in an average patient losing nearly 23% of their body weight. You know what? I think this study makes it much more likely that the FDA will clear the drug for mass use to stop diabetes. And because there's no real alternative, I don't see how the insurance companies can avoid paying for these GLP-1 wonder drugs. So many are worried. I feel better about this. As Lilly CEO David Ricks told us this morning on Squawk on the Street, the drug will save the system a lot of money.
I think the question 2 years ago was, do these drugs, does tirzepatide, a dual-acting GIP-GLP inhibitor, actually not only keep you thinner, but keep you healthier? And we're beginning to learn that it keeps you healthier. Both the federal government doesn't pay for these. Many employers don't. They should. This is going to save money for our country in the long term and keep people living a healthier, longer life.
I've been a huge supporter of Eli Lilly for ages, precisely for the reasons Rick just went over. And it's a major position the travel trusts. I know this kind of news will bring in new believers. So will David's assurances that they're working on every single formulation you keep hearing these competitors jabber about all the time. Oh, pill form, once a month shot, injected with 4 doses instead of 1. They're working on all these. Lilly's spending $18 billion to build up manufacturing facilities for these drugs, something that almost no other drug company can afford. Sure, the competitors might have something up their sleeve, but right now, the clear winner is Lilly, with Novo Nordisk a decent second place. The rest, well, let's just say they're still stuck in the FDA approval process that will likely take multiple years for them to play out. Lilly started this odyssey back in 2016, for heaven's sake. The others are nowhere close. I think there's a gross misunderstanding of what's going to happen with this drug. It's not just for weight loss and diabetes. It'll be prescribed for everything from congestive heart failure, lymphatic liver disease, hypertension, all killers, which is why I always say it'll be the biggest drug of all time. And mind you, I'm not just talking about these life-saving uses. This thing cuts back on your craving for liquor. Liquor's so bad for you. It could someday be a legitimate treatment for alcoholism. It works for sleep apnea. There are many other illnesses and behavioral problems that the GLP-1s will likely solve. That's why it wouldn't shock me if Eli Lilly, currently worth $902 billion, eventually becomes the first non-tech company to join the $1 trillion club. Everybody's always searching for the drug company that can knock Lilly off its perch. But I think people should be more cognizant that Lilly's got a deep moat protected from competition. I know the stock wasn't able to close above its previous highs today, and for some of you, that probably signaled some sort of double top and a failure. I urge you to think bigger, please. One day we'll recognize that tens of millions of people have been freed from the tyranny of a diet and exercise regimen. And it's all thanks to Eli Lilly. I'd like to say there's always more market summer. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.